So the first thing I want to show you, again, I'm going to show you three things. First thing is non-farm payrolls in context. Now again, we have to pull back the data series. Instead of listening to people just talk, wah, 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 just look at the math. It's not that complicated. So what we're showing you here is non-farm payrolls. Again, the 151,000 number really doesn't matter to us. What matters is the rate of change within the cycle. So what you see here is the long-term cycle of the number everyone's talking about, which is NFP, year over year. So that shows you the rate of change. The year over year percentage change in non-farm payrolls has peaked. The official peak is in, which we've been saying and saying and saying really for a year now, because it peaked last year at 2.34%. So you can see that 2.3% box is actually right around what the average was for the first quarter of last year. Now this morning's non-farm payroll number was 1.9% year over year. So again, that's why I'm showing a red line hooking down there, because the rate of change in jobs growth is now slowing. And again, it actually has been slowing for more than a couple months. But the bond market already knows that. The stock market already knows that. The question is, when does it stop slowing? And as you'll note, that ain't going to stop slowing, my friends and foes. This is going to continue. It's called a cycle. If you missed it, too bad. Again, that's what it is. Second chart, Challenger job cuts. Now this is released yesterday. This is a spike. So you look at this on a year-over-year basis, the job cut announcements was up 42% year over year. Now that's a ton. That's a pretty good leading indicator for next month's jobs report. So again, if you look at what's going on in the energy patch, you can see the black line. You can see total, obviously, as well. And this is a very bad picture. So again, that's more of a real-time update on people losing their jobs. Now finally, the picture that reflects on all this is Mr. Bond Market. So if you look at Mr. Bond Market, he's saying, whoa, Nelly, whoa, slow, get low. Get Low. Have you seen that movie, Get Low? That's a little bit more of a morbid kind of a show. But I mean, the reality is that you're getting pretty low here. You're getting paid too. Getting paid on the long bond, you are. Yeah, you like that? I know you like it. It's great. I mean, look, at the end of the day, and that was the quote before the jobs report, 1.85%. There's no immediate term trade support to 1.81%, and our intermediate term call continues to be 1.7% on the 10-year bond yield. So again, if you get the rate of change of growth right, specifically in late cycle indicators like employment and consumption, you have gotten most of the macro market right. And that's why you pay us, and we're happy and humbled that you're staying with us today.